Investing into the stock market has never been easier, and with the growth of ETFs rising significantly over the past few years, I'm about to break down 6 of the best overall ETFs to consider buying in 2026, and I'll even mention by the end of the video a few bonus ones that are my personal favorites that I think you'll really find interesting to at least know about. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, the first one to go over is the Vanguard S&P 500 ETF with the ticker of VOO. Now, VOO tracks the S&P 500 index, which means it represents 500 of the largest US-based companies and is considered a gauge of overall US stock returns. And so the key things to know about VOO include the fact that the fund initially launched in September of 2010, and it is currently the #1 largest ETF in the market based on its assets under management that is currently $855 billion. Besides that, VOO has an expense ratio of 0.03%, which means for every $10,000 that you invest, you would pay $3 per year in fees. And do know that that amount is automatically taken out of your investment over time. It's not something that you have to pay separately. Aside from that, VOO currently has 504 holdings, where the top companies you probably heard of, like Nvidia, Apple, or Microsoft, where each of these companies make up about 6 to 8% of the entire fund. And so when we go to add up those top 10 holdings, they make up almost 40% of the entire fund's weight. And largely because of that, the largest sector in the fund is made up of technology at about 34% of the entire weight of the fund. But moving on from there, VOO has computed a dividend yield over the past 12 months to generate a 1.12% yield. And to understand the tax efficiency, which is crucial if you are investing in a normal taxable brokerage account, VOO, as of 2025 reports, has computed to offer investors that hold onto the fund long enough that it could distribute 97% of its dividends as qualified dividends, which means they could be taxed at the long-term capital gains tax rates, which are much more favorable. Besides that, VOO also pays dividends out on a quarterly basis. The fund has also grown almost 18% over the past year. Over the past 3, it's averaged about 23% per year in growth. Over the past 5 was about 14.4%. And then if we look over the past 10 years, the fund has grown on average 14.78% per year. Which do know that these numbers include the expense ratio factored into them, and they assume that you are going to reinvest the dividends. But understand the importance and reasonings on why I mentioned the dividend payout and the potential of qualified dividends. Because if you are one investing in a normal taxable brokerage account, dividends are taxed regardless of whether you reinvest them or not, which can create what's called tax drag, which can impact how much you actually end up keeping in your pocket over time. And so that alone is exactly why the next ETF that I'm about to mention is my favorite overall one right now, and that is the Schwab US Large Cap Growth ETF with the ticker of SCHG. Now, SCHG has been a personal favorite of mine for quite some time now, and the first thing to realize here is that the fund tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is very similar to VOO, but now it provides simple access to solely large cap US equities that exhibit growth style characteristics. And so this fund initially was created in December of 2009. It currently has $52 billion in assets under its management, which I have to mention to those growth investors out there, there are 2 very other popular alternatives that you probably heard about besides SCHG that I'd also recommend, which are QQQ. If you are investing solely for the long term, you may consider QQQM, or Vanguard's growth ETF VUG. Now, of those funds, they're all very similar, but they do have slight differences. And if we look at SCHG, the fund currently has a 0.04% expense ratio. It currently has 198 holdings in the fund, where the top companies, if you look, they are very similar to the S&P 500's VOO that I just showed. But now you can see the top ones like Nvidia, Apple, and Microsoft, they each have more weight towards them, where that's currently about 8 to 11% of the entire fund. And so because of that, if we were to go and add those top 10 holdings up, they make up 58% of the entire fund, which is also why technology is the largest sector and even higher than the S&P 500, where for SCHG, technology makes up about 48% of the entire fund. Not to mention, but one of my favorite parts about SCHG for taxable investing especially is that over the past 12 months, it has paid out a 0.36% dividend yield, which can be treated as pretty much all qualified dividends if you held on to it long enough. So this is a very, very tax efficient investment. But knowing that SCHG pays out dividends on a quarterly basis, over the past year, the fund has grown 17.5%. Over the past 3 years, it's averaged 33.5% of growth. The past 5-year average was almost 16%. And over the past 10 years, the fund has grown 18.17%, which means it would have outperformed the S&P 500 by over 3% per year. And not to mention, but one data point I love looking at when I compare ETFs, and one I recommend at least considering, is the amount of overlap that each one has by weight with the S&P 500, where you can see that for VOO compared to SCHG, there is a 54% overlap by weight between the two funds. The overlap numbers here are very similar with VUG and QQQ, so if you are interested in the other options, I would ideally just stick with one that you prefer most. But all in all, remember that this is a more growth-oriented ETF than simply just getting the S&P 500, so there's likely to be even more volatility with this type of investment. But speaking of the S&P 500, one of my new favorites I strongly recommend you know about is the Invesco S&P 500 Momentum ETF with a ticker of SPMO. Now, as you can see, SPMO tracks the S&P 500 Momentum Index, which means it tracks the performance of stocks in the S&P 500 index that have a high momentum score. To keep this brief, just understand that the index first calculates the momentum score of each stock in the S&P 500 index by evaluating the percentage change in the stock's price over the last 12 months, excluding the most recent month, and it applies an adjustment based on the security's volatility over that period. All in all, this is a very interesting ETF to know about that just crossed the 10-year mark, which is something I love to see. Where it officially launched in October of 2015, the fund currently has $13 billion in assets under its management. It has a 0.13% expense ratio, currently has 100 holdings, where the top 10 holdings make up just over 50% of the entire weight, which that weight is coming from slightly different companies than the S&P 500, where top ones you can now see include Broadcom, JP Morgan, Palantir, or General Electric, to name a few. Which, not to mention, but the overall technology exposure in this fund is 34% of the weight. And then if we look at the dividend yield over the past 12 months, it computed a 0.74% yield. But do know that the fund has paid out dividends on a quarterly basis. Over the past year, it's grown almost 27%. Over the past 3, it's averaged about 29.5%. Over the past 5, that's about 19%. And over the past 10 years, it has averaged 17.85% per year, which is about 3% more per year than the S&P 500. Which I have to mention, because this fund has really interested me lately, also know that the best year it's had over the past 10 years was up almost 46%, where the S&P 500's 31%, and not just that, but the worst year for SPMO over the past 10 years was down only 10%, when compared to VOO, that was 18%. And then the last thing I like about SPMO is that the overlap by weight with the S&P 500 is only 30%. Now, before I move on, do know that the research tools I used for this video, I remain consistent with across the board for each of the data points, where things like the expense ratio or underlying index all come from each fund's official website. The dividend yields came from Seeking Alpha. The overlap for the S&P 500 came from the ETF Research Center. And if you want to see some of the top financial tools, top brokerage accounts currently in the market, or even our free index fund cheat sheet that covers some of our top index funds, I'll have direct links in the description below for you. But speaking about momentum ETFs, another interesting one to know about is the Invesco S&P MidCap Momentum ETF with a ticker of XMMO. Now, XMMO has a very similar momentum concept to SPMO, but now this fund uses the S&P MidCap 400 Index, where it takes approximately 80 of the securities with the highest momentum scores that are included in the index. And so this fund has actually been around since March of 2005. It has $5 billion in assets under its management. It has a 0.35% expense ratio, 79 total holdings, where the top 10 make up about 33% of the entire fund. Technology makes up about 20% of the fund. The dividend yield over the past 12 months was 0.76%, but do know that the fund pays out dividends on a quarterly basis. Over the past year, it's grown about 13%. Over the past 3 years, it's averaged about 23.3%. Over the past 5, that was about 13%. And then over the past 10 years, it's averaged about 17.3% per year. And do know that there is a 0% overlap by weight here between XMMO and the S&P 500. But knowing that, the next ETF on the list is the Avantis US Small Cap Value ETF with the ticker of AVUV. Now, AVUV is another very interesting one to know about, and yes, it is a value-oriented ETF, but of all the small cap exposure ETFs that I've researched, I personally found this one to be the best overall option. And so the first thing to know about AVUV is that the fund's underlying index is the Russell 2000 Value Index, but do know that this is actually an actively managed fund where AVUV invests in a broad set of US small companies and is designed to increase expected returns by focusing on firms trading at what they believe to be low valuations with higher profitability ratios. And so this fund, launched in September of 2019, has $22 billion in assets under its management. It has a 0.25% expense ratio, currently has 784 holdings, where the top 10 only make up about 8% of the entire fund, where technology is only exposed to about 6% of the entire weight. Not to mention, but AVUV also has a higher dividend yield at 1.46% over the past 12 months, but do know as of 2024 reports that you could potentially reap 100% in qualified dividends if you held it long enough. Now, this fund also pays out dividends on a quarterly basis. It's grown 7.5% over the past year. Over the past 3 years, that's averaged about 13%. Over the past 5 is about 14.3%. And because it was launched in 2019, we don't have enough data to look at the 10-year returns. But another nice perk about this fund, if you're one looking to diversify your investments, is that there is a 0% overlap by weight between AVUV and the S&P 500. All right, so knowing that, the last one to mention here is for broad international exposure, with the top one currently being the Vanguard FTSE Developed Markets ETF, with the ticker of VEA. Now realize that there are a few other broad international ETFs that are solid options, like VXUS or IEFA, that really just differ based off the type of exposure that you want. But as far as VEA, this fund tracks the FTSE Developed All Cap excluding the US index, where you can see the top markets that it's exposed to include Japan, the UK, Canada, France, Switzerland, Germany, you name it. And so this fund initially launched in July of 2007. It is currently the 6th largest ETF in the market with $202 billion in assets under its management, where the fund also has a low expense ratio of 0.03%, a total of 3,853 holdings, where the top 10 make up about 10% of the entire fund. And then if we look at technology, it has just over 11.5% of the weight toward the fund. Now, one thing to really understand about international funds is that they typically pay out a high dividend yield and that they're not very tax efficient. So if we look at the dividend yield over the past 12 months, it generated 3.05% yield. And as of 2025, it reported to offer investors about 66% in qualified dividends if they held on long enough. So just be aware of that tax efficiency when it comes to gaining international exposure, because a personal note of mine is that I actually prefer to solely keep international funds in tax-advantaged accounts like my Roth IRA. But besides that, the fund pays out dividends on a quarterly basis. Over the past year, it's also grown just over 35%, which is about double the performance of the S&P 500. And then if we look at the average over the past 3 years, that is about 18% per year. Over the past 5, it was 9.2%. And then if we look over the past 10 years, VEA has grown about 8.75% per year. But knowing all that, the last point is that VEA has a 0% overlap by weight with the S&P 500. All right, so that covers the 6 overall best ETFs that I believe are currently available in the market. If you have any suggestions, consider adding any of your own favorites in the comments below so that others and I can see and learn more about other options. But before we end this, to give you a final bonus of other top ETFs that I've been buying and personally like, here is a quick bonus section. All right, so the first one to point out here, just be aware of the additional risk because it has been doing extremely well recently, and that is through the Van Eck Semiconductor ETF with the ticker of SMH. But the key things to realize here is that the fund is made up of 26 holdings, where the top 10 make up about 74% of the entire fund, so it's very heavily weighted toward many of the top companies. It also pays out a super low dividend yield of 0.28%, where they could be 100% qualified dividends if you held on long enough. And over the past 10 years, this fund has done extremely well, averaging about 31% per year. but please remember that the past does not guarantee the future. Now, understand that many of these ETFs also have many alternatives, so if you want to learn more about others, you can see more in our free index fund cheat sheet that we'll have linked in the description below. And also, while you're at it, consider saving the index fund cheat sheet because we are continuously updating that, and that is a live document. But the next one here to know about is the Vanguard Information Technology ETF with the ticker of VGT, where this also has a super low dividend yield of 0.4%. Over the past 10 years, it's averaged 22.5% per year. There's a 34% overlap by weight with the S&P 500, and a lot of these bonus ones I'm mentioning have low overlap with the S&P 500. Which leads me into the next one for those that are seeking dividends, and that is through the Schwab US Dividend Equity ETF with the ticker of SCHG that has 102 holdings, but over the past 12 months, it's paid out a 3.6% dividend yield that could potentially be 100% qualified dividends. It pays them out on a quarterly basis, but do know the average returns over time are slightly less than the S&P 500, but the nice part is diversification because there's only a 7% overlap by weight with SCHD between the S&P 500. Then the next one here to mention that's also done extremely well recently, so be aware of that, but that is by investing into gold through the Spider Gold Mini Shares ETF with the ticker of GLD or GLDM if you are solely long-term investing, and that is because the expense ratio for GLD is 0.4% compared to GLDM at 0.1. But when it comes to gold, just realize that it pays no dividend, and over the past year, it's done extremely well by growing about 64%, and over the past 10 years, it's averaged 14.6% per year. Now, like I said, understanding the risk associated with each ETF that you invest into is crucial to understand, as well as this next ETF that is the Fidelity Wise Origin Bitcoin Fund with the ticker of FBTC, where this allows you to easily gain access to the price of Bitcoin. And if you are one looking for a more liquid ETF, iShares with the ticker of IBIT is the most popular option, but do know that Fidelity's FBTC has a 0.25% expense ratio. It tracks Bitcoin, and if we look at the actual index for the historical data rather than the actual ETF because it launched in 2024, over the past 10 years, Bitcoin has grown about 70% per year, but now that it has gone mainstream, do not expect that type of growth in the future. Then the last one I have to mention here that I think many will find very interesting if you want international exposure, but potentially more growth, is through the Invesco S&P International Developed Momentum ETF with the ticker of IDMO. Now, of all the international ETFs that I have researched, I personally have found this one to be the best overall option for growth, where you can see this fund has a 0.25% expense ratio. It's smaller with $3 billion in assets under its management, but over the past year, it's grown 42%, and over the past 10 years, which it's been around since 2012, has averaged 12% per year. Now, when compared to VEA, there are less holdings, and it does have a higher dividend yield and less tax efficiency, but if you are investing in a tax-advantaged account for the long term, I really don't see anything wrong with IDMO. But of course, in the end, you have to do your own research and make your own financial decisions. But if you want to see some of our other top ETFs, like I said, consider checking out our free index fund cheat sheet that is linked in the description below. And while you're at it, consider joining our newsletters to stay ahead of your finances. And don't forget, if you want to start investing on a new platform, check out other free content or even some of our top investing tools and resources. We'll have direct links in the description below for you. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Which, if you found value in this video, don't forget to hit the like and subscribe button for future content like this.